Here is the uncomfortable reality. The market does not reward intelligence. It punishes emotional confidence. Most amateurs believe knowledge equals profit. Professionals know risk management equals survival. Nicholas Darvas learned this the hard way. He entered markets with excitement, not structure. Early wins inflated ego. Losses arrived immediately after. Darvas once made a fast profit and doubled his position size without confirmation. Confidence replaced discipline. The trade reversed. Weeks of gains vanished in days. That single moment burned a lesson deeper than any book. The market does not care how smart you feel, only how controlled you are. Amateurs trade to feel right, to prove something, to chase validation. Professionals trade to stay alive, to preserve capital, to earn another day of opportunity. Darvas realized something most traders never accept. Survival is the first skill. Profit is a distant byproduct. When survival becomes the goal, behavior changes. He stopped predicting direction. He stopped chasing tips whispered by confident voices. He stopped listening to stories designed to excite greed or soothe fear. He began watching the tape with cold attention. Price only. Behavior only. No opinions. No hope. Here is the paradox that reshapes everything. The more emotional effort you apply, the worse results become. Forcing trades feels productive, but it is destructive. Darvas reframed his identity completely. He stopped being a gambler searching for excitement. He became a risk manager enforcing boundaries. Fear and greed did not disappear. They never do. They were contained through rules that operated when emotions could not. This shift created the foundation of his fortune. Without it, no strategy survives. Once risk is mastered, patience becomes profitable. Patience without risk is fantasy. Risk without patience is chaos. Darvas understood that every trade is a probability, not a promise. He accepted uncertainty as permanent. That acceptance removed the need to be right. Instead, he focused on being disciplined. He sized positions small enough to think clearly. He defined stop-loss levels before entering. He respected pivotal points on the chart instead of personal opinions. Each rule acted like a circuit breaker against fear and greed. When the tape contradicted him, he exited without debate. That behavior separated him from amateurs who negotiate with losses. Professionals do not negotiate. They execute. Darvas learned that doing nothing is often the highest form of discipline. Waiting as a position preserved capital and mental clarity. While others traded constantly, he observed quietly. He allowed structures to form. He allowed confirmation to appear. He trusted that missing trades was cheaper than forcing them. This patience was not passive. It was active restraint. It sharpened his perception. It trained his mind to see pivotal moments clearly. Over time, this approach rewired his psychology. Losses stopped feeling personal. Wins stopped feeling intoxicating. Both became data. That emotional neutrality unlocked consistency. Consistency unlocked compounding. Darvas did not search for fortune directly. He built a process that allowed fortune to emerge naturally. Every rule existed for one reason: to keep him in the game long enough for probabilities to work. That is the edge most traders ignore. Not entry timing. Not indicators. Not predictions. Control. Control of risk. Control of position size. Control of behavior under pressure. When control becomes identity, outcomes change. That is why Darvas moved from chaos to clarity. And that is why understanding risk, before anything else, determines whether patience rewards you or destroys you. Most traders skip this lesson and search endlessly for better entries. Darvas ignored noise and protected capital relentlessly. He trusted numbers over narratives and rules over impulses. That discipline created freedom. Freedom created longevity. Longevity allowed luck to matter. This is why mastery begins with defense, not attack, and why professionals survive long enough to let probability eventually bend in their favor. Without this foundation, every strategy collapses when pressure rises and emotions demand action instead of patience under real market stress and uncertainty always present. Most traders ask, "How much can I make?" Professionals ask, "How much can I lose?" That single question exposes everything about a trader's future. Nicholas Darvas flipped the question early in his transformation, and that single flip quietly changed his entire career. He stopped fantasizing about upside and started defining downside. Mini story. Darvas entered a clean breakout near a pivotal point that looked perfect on the tape. Before buying, he calculated the loss, not the upside, not the dream scenario, only the loss. If that loss felt uncomfortable, the trade was wrong. Not the setup, not the market, the size. That rule saved him repeatedly. If risk is unclear, the trade does not exist. Darvas capped risk at a fixed percentage, usually 1 to 2% per trade, never more. This did something powerful inside his mind. It removed fear. Fear comes from oversized risk, not from uncertainty. Uncertainty is permanent. Oversizing is optional. Amateurs hope the market forgives them. Professionals calculate, so forgiveness is never needed. Risk control gave Darvas freedom most traders never experience. Freedom to wait without anxiety. Freedom to exit without hesitation. Freedom to re-enter without emotional baggage. Another paradox revealed itself quickly. Small losses are signs of professionalism. Large losses are signs of ego. Darvas never tried to recover losses quickly. He never chased to feel whole again. He accepted losses instantly as part of the process. That acceptance allowed patience to finally work. Patience without risk control is fantasy. Waiting only becomes profitable when risk is already contained. Otherwise, waiting becomes denial. Darvas understood that waiting must be strategic, not emotional. Strategic waiting comes from knowing the worst-case outcome in advance. Emotional waiting comes from fear of being wrong. Here is the key insight most traders miss. Risk defines behavior. Behavior defines results. When risk is large, behavior becomes defensive and reactive. When risk is controlled, behavior becomes calm and objective. Once risk was fixed, Darvas could focus on structure, because structure requires clarity. And structure lives in position size. That is where most traders silently destroy themselves. They find good setups and sabotage them with bad sizing. Darvas refused to do that. He treated position size as a lever, not a weapon. Smaller size allowed him to think clearly while watching the tape. Clear thinking revealed whether price respected the pivotal point or rejected it. He never argued with that information. He obeyed it. Fear and greed still appeared, but they lost their power. Rules replaced impulses. Losses stopped feeling personal. Wins stopped feeling urgent. Everything became procedural. Darvas realized that risk management is not defensive trading, it is offensive survival. Survive long enough and probabilities start to work in your favor. Blow up once and the game ends. This is why professionals obsess over downside while amateurs dream about upside. Upside is optional. Downside is mandatory. When traders ignore this, position size expands silently until one mistake becomes catastrophic. Darvas saw accounts destroyed this way and refused to join them. He understood that controlling risk was not about avoiding losses. It was about controlling himself under pressure. Once that control existed, patience transformed from frustration into advantage. Waiting became purposeful. Entries became selective. Exits became automatic. And trading finally felt boring, which is exactly how professionalism feels. This discipline prepared him for the next layer of mastery, because once risk is contained and size is controlled, the mind is finally ready to see the market clearly instead of emotionally reacting to every fluctuation on the tape. Two traders take the same trade. One survives. One blows up. The difference is not intelligence. It is position size. That single variable decides whether pressure sharpens judgment or destroys discipline. Mini story. Darvas found a strong breakout after weeks of watching the tape. Everything aligned. The box was clean. Volume confirmed. Instead of going big, he went small. The breakout failed. Loss was minor, almost forgettable. Days later, the real move came with force and clarity. Now he added carefully. That decision separated him from amateurs who would have been shaken out emotionally and financially. Takeaway rule. Size small until price proves you correct. Amateur size based on emotion. Professional size based on math. Darvas adjusted size based on stop distance every time. Wide stop, smaller size. Tight stop, controlled increase. Risk stayed constant. Only exposure changed. This prevented emotional attachment. Emotion clouds execution faster than ignorance. When size is too large, every tick feels personal. When size is controlled, price becomes information. Another paradox emerges here. Confidence grows after profit, not before. Amateurs size up because they feel confident. Professionals gain confidence because rules protected them through uncertainty. Darvas never increased size on losing trades. Ever. That is where amateurs collapse. They average down, hoping price forgives them. Professionals wait for confirmation and let price invite them back in. Position size controls fear and greed, not willpower, not motivation, not disciplined speeches. Rules do the work when emotions cannot. Darvas understood that the mind cannot be trusted under financial pressure. Structure must replace emotion. Once size was controlled, Darvas could finally use stop losses correctly. Stops stopped feeling painful because losses were already acceptable. That unlocked the most misunderstood weapon in trading. Proper stops create freedom. Freedom to exit. Freedom to re-enter. Freedom to wait without fear. Most traders place stops randomly, then violate them emotionally. Darvas placed stops logically and honored them mechanically. Position size made that possible. Without correct size, stops feel threatening. With correct size, stops feel neutral. That neutrality changed everything. Darvas saw position size as the steering wheel of the trade. Entry was the engine. Stop loss was the brake. Without a steering wheel, speed becomes danger. With it, control emerges. He realized that good analysis fails when paired with bad sizing. Bad analysis can survive when paired with good sizing. This reversed how he evaluated trades. He stopped asking if a trade was exciting. He asked if the size allowed him to think clearly. Clear thinking became the filter. The tape revealed truth faster when emotion was removed. Fear appeared less often. Greed lost urgency. Trades became calm decisions instead of emotional events. Darvas noticed something subtle over time. Smaller size increased patience. Patience increased selectivity. Selectivity improved win quality. That is how compounding begins, quietly and slowly. Many traders believe size is about maximizing profit. Darvas' new size is about minimizing mistakes. Minimize mistakes long enough and profits take care of themselves. He also understood that position size is dynamic, not fixed. It responds to volatility, structure, and confirmation. Size shrinks during uncertainty. Size expands after validation. This adaptability kept him aligned with the market instead of fighting it. Amateurs fight price with size. Professionals flow with price using size. That distinction determines survival. Darvas never tried to impress the market. He respected it. Position size was his language of respect. Through that respect, clarity emerged. Through clarity, consistency followed. And consistency created the conditions where stop losses became tools instead of threats, preparing him for the deeper discipline that few traders ever master. Most traders treat stop losses as optional, bending them to hope, rumor, or gut feeling. Darvas treated them as law, a mechanical non-negotiable boundary that protected his mind and capital alike. Mini-story. A stock dipped slightly below his stop after showing weakness near a pivotal point. No news. No panic. He exited instantly. Days later, it collapsed dramatically. Others froze, emotionally trapped, watching their accounts bleed. Darvas preserved capital effortlessly because he obeyed the rules, not his feelings. Takeaway rule. A stop loss protects discipline, not money. Amateurs widen stops, hoping the market forgives them. Professionals exit without emotion, treating loss as a cost of playing the game, not a reflection of personal failure. Darvas accepted being wrong quickly, embracing a principle most traders fight daily. You do not need high accuracy to succeed, you need controlled losses. Stop losses remove hope, and hope is expensive. It inflates ego, delays clarity, and forces unnecessary risk. By respecting stops, he freed himself to trade with focus, patience, and detachment. This created patience, real patience, not denial masquerading as discipline. Many traders wait, hoping a trade returns, mistaking hope for strategy. Darvas waited for confirmation, structure, and the tape, not wishes. Another paradox emerges here. The fastest way to win is accepting losses early. Amateurs argue with the market, fighting every tick. Professionals obey the tape, letting rules dictate their actions. The tape decides, opinion does not. This obedience removes emotional friction, replacing anxiety with clarity. With stops respected, he could finally wait. Waiting became his edge. While amateurs chased price and acted on impulse, Darvas observed quietly. He allowed structures to form. He allowed boxes to complete. He allowed volume to confirm strength before committing additional capital. Waiting as a position is active, not passive. Each tick he ignored sharpened his perception, trained his patience, and preserved his capital. Stops and patience together create a cycle. Capital preserved allows clear observation. Clear observation identifies pivotal points. Pivotal points create selective entries. Selective entries compound profits while minimizing losses. Darvas understood that without stops, even the best setups can destroy accounts. Without patience, even the clearest structures become tempting traps. Another subtle truth he discovered is that early loss acceptance neutralizes fear. Fear from oversized positions or prolonged exposure clouds judgment. By limiting risk and accepting stops instantly, fear diminishes, leaving the mind free to observe, analyze, and execute with precision. Amateurs fight fear with wishful thinking. Professionals fight fear with rules. Discipline, clarity, and structure replace emotional interference. Each trade becomes procedural, predictable in terms of behavior, even if outcomes remain uncertain. The combination of stops and waiting allowed Darvas to let probabilities work without interference. He never argued with price. He never debated his rules. He simply executed, observing as the market revealed truth, letting only confirmations guide new entries. Patience becomes profitable only when you have eliminated the risk of catastrophic error. Without control over position size, without respecting stops, waiting is meaningless. It is passive hope, not strategic restraint. With both elements mastered, the trader becomes untouchable by emotion, able to see pivotal points clearly, act selectively, and allow the market to reward consistency over ego. This is why Darvas turned rules into freedom, fear into insight, and patience into his most powerful weapon. Doing nothing feels like failure to most traders. The itch to act, to enter, to prove oneself, drives constant motion. Professionals know it is strength, a deliberate form of control that the market rarely rewards explicitly but always notices implicitly. Darvas waited. Weeks without trading, observing patiently as boxes formed on the tape, price moving within defined structures. He let amateurs exhaust themselves, chasing every minor fluctuation, burning capital and confidence alike. Mini story. He skipped multiple breakouts that lacked confirmation. Others chased them, riding hope instead of structure. Most failed, caught in false moves, their accounts leaking silently. When structure finally aligned, when price respected pivotal points and volume confirmed conviction, the move was obvious, almost lazy in its clarity. Takeaway rule. Waiting is an active decision, not inactivity. Amateurs feel compelled to act. They seek constant participation to prove intelligence or courage. Professionals seek confirmation. They act when rules, structure, and tape align. Waiting reduces over-trading. Less trading means fewer mistakes. Each pause preserves capital, focus, and psychological bandwidth. Another paradox emerges. The market pays patience, not effort. Activity is cheap and abundant. Precision is rare. Darvas waited at pivotal points, not in the middle of noise, filtering out distraction. Waiting sharpened judgment, training the mind to detect strength, volume, and subtle shifts that amateurs consistently miss. Judgment improved execution. Each selective trade became higher quality because patience allowed proper observation, proper positioning, and proper timing. Waiting also created space for fear and greed to dissipate. Those emotions thrive under constant action. By stepping back, Darvas let the tape reveal truth without interference. He learned that entering prematurely invites uncertainty, while waiting allows probability to work in his favor. Once waiting was mastered, Darvas could apply pyramiding safely, adding to winners only after clear confirmation. Mini story. He observed a breakout, confirmed by volume and structure, and added in measured increments. Each addition respected risk and stop parameters. The market allowed expansion precisely because he had waited. Amateurs often pyramid out of greed, inflating position size during uncertainty, creating chaos. Professionals pyramid from strength, using confirmation as the guide. Waiting is not boredom, it is preparation. The tape whispers secrets to those who listen. Darvas cultivated the discipline to listen quietly, acting only when probability was evident. That patience turned ordinary moves into significant gains over time. Another paradox. Doing nothing often becomes doing everything right. By observing, not reacting, he preserved capital, trained judgment, and built confidence without exposure. Waiting as a position ensures trades are entered rationally, exits are logical, and pyramiding is executed with calculated risk. It also conditions the mind to detach from the outcome, focusing purely on execution. Amateurs fear missed opportunities, professionals fear uncontrolled exposure. By mastering waiting, Darvas controlled both risk and psychology simultaneously. He transformed inactivity into a strategic advantage, allowing market structure to dictate action rather than emotion. Patience became a weapon, selective action became precision, and the combination elevated his trading from reactive to proactive mastery. The true lesson is that time in the market, observed intelligently and patiently, compounds insight, creating an edge that few realize exists. Most traders pyramid losers, adding to losing positions in the hope that price will reverse, fueled by emotion and denial. Darvas pyramid winners. He understood that adding to a winning trade is not about greed, it is about disciplined expansion under controlled risk. Mini story. A breakout worked as expected. Price confirmed strength with volume and structure. He added a partial position. Then he added again, smaller than before, never violating his risk parameters. Risk stayed constant. Exposure increased only after confirmation, never based on hope or wishful thinking. Takeaway rule. Only winners deserve more capital. Amateurs add from hope, chasing validation or ego. Professionals add from strength, letting price and tape dictate allocation. Each additional unit is earned, not assumed. Pyramiding turns small wins into large fortunes, compounding slowly and safely without increasing risk beyond tolerable limits. This is the critical difference that separates amateurs from professionals. Another paradox arises. Big money is made by adding slowly, not by betting big at the first sign of strength. Impatience destroys accounts. Darvas saw traders overcommit to early moves, then panic when minor pullbacks occurred. He refused that path. Instead, he trusted the tape, not opinions, not narratives, not advice from newsletters or brokers. The tape provided confirmation and discipline. This approach completed his execution framework, tying together position size, stop loss, patience, and structure into a coherent system. Mini story. On one trade, he entered a breakout conservatively, watched the move, and only added after each successful pivot confirmation. By the end, the position had doubled in size without ever exceeding his risk threshold. His account grew predictably, with controlled exposure, while amateurs chasing the same stock blew up or exited prematurely. Darvas understood that pyramiding without control is gambling disguised as strategy. Pyramiding with rules is compounding disguised as simplicity. Each incremental addition respects stops, structure, and pivotal points. The process itself enforces discipline, reducing the role of emotion. Another key insight is that patience and timing magnify the effectiveness of pyramiding. Waiting for confirmation before adding ensures that each unit contributes positively to overall expectancy. By contrast, emotional pyramiding often converts winning trades into losers. Darvas also recognized that risk per increment must shrink relative to the accumulated position. As the position grows, each new addition carries proportionally less absolute risk, preserving the integrity of the overall account. This principle allowed him to scale consistently over time. Furthermore, pyramiding serves as a natural filter for psychological resilience. Only trades that survive scrutiny, confirmation, and time earn the opportunity for expansion. Amateurs fail this test constantly, mistaking luck for skill. Professionals, following rules and tape confirmation, Compound wins while surviving all market conditions. By mastering pyramiding, Darvas combined patience, confirmation, risk control, and disciplined action into a seamless system. It was not flashy. It was not about prediction. It was about execution. The market revealed opportunity, and he responded methodically. This completion of his execution framework transformed trading from reactive speculation into disciplined, repeatable growth. Every rule reinforced the others, creating a self-correcting loop that turned disciplined behavior into profitable outcomes over time. Execution, not insight, became the ultimate edge. Fear signals oversizing. Greed signals broken rules. Most traders ignore these signals, treating fear as weakness and greed as opportunity. Darvas didn't fight emotion. He designed rules to neutralize it, converting emotional signals into behavioral data. Mini story. When fear appeared during a volatile breakout, he reduced position size immediately, preserving capital and clarity. When greed appeared after an extended move, he reviewed his rules instead of chasing further exposure, ensuring that every action aligned with structure and risk tolerance. Takeaway rule. Emotion is feedback, not an enemy. Amateurs fight it, arguing with fear and indulging in greed, often creating catastrophic losses. Professionals manage behavior, using rules as the interface between psychology and execution. Identity matters. Darvas stopped trying to be right about direction, timing, or market opinion. He focused on being consistent in process and execution. Consistency created confidence, confidence reinforced rules, and rules maintained discipline. Fear was no longer panic, it was a signal to reassess risk. Greed was no longer temptation, it was a reminder to honor structure. This shift changed his relationship with every trade. Mini story. During a breakout that many traders called perfect, fear crept in as price tested a pivotal point. Darvas did not exit prematurely, nor did he add impulsively. He reviewed position size, verified stop placement, and waited. The tape confirmed continuation, and only then did he scale. Without this emotional feedback loop, he would have been forced into rash decisions. Another paradox emerges. The less you try to control emotion, the more control you gain. Darvas allowed emotions to inform him without dictating action. He never suppressed fear, nor did he indulge greed. Both became indicators, not motivators. Professionals use emotion as a sensor, amateurs as a throttle. Darvas also realized that identity is the ultimate leverage in trading. If you identify as a gambler, you will act impulsively, ignoring rules. If you identify as a disciplined executor, you will follow process despite market chaos. By reshaping identity, he created a mental environment where rules could function without interference. Mini story. On a day when the market swung violently, many traders exited in panic. Darvas remained calm, adhering strictly to his size, stops, and confirmation protocols. His behavior created predictability in an unpredictable environment, producing consistent results over time. The integration of emotion management into the execution framework completed a vital layer of his method. Fear no longer paralyzed him. Greed no longer misled him. Both informed adjustment, scaling, and timing. This allowed him to remain patient at pivotal points, add to confirmed winners, and avoid losses that amateurs treat as unavoidable. Another subtle truth is that confidence generated from consistency outperforms confidence generated from wins. Traders who rely on ego-driven confidence tend to overtrade. Traders who rely on process-driven confidence compound skill and capital over time. Darvas' framework turned psychological awareness into operational discipline. Every trade, every position, every pyramid was executed with awareness but without interference from raw emotion. This transformation is what separates amateurs from professionals. Professionals survive long enough to let probabilities work. Amateurs react to feelings, letting probabilities slip away. By converting fear and greed into feedback rather than enemies, Darvas neutralized psychological risk and amplified behavioral control, creating the invisible edge that underlies every successful trade. Darvas never predicted. He understood early that forecasting is a trap. The market does not conform to opinion or expectation. Instead, he waited for confirmation. He observed structure, price behavior, and pivotal points, letting the tape dictate timing. Mini story. Many stocks appeared cheap to him and to the crowd. Analysts and newsletters praised potential breakouts. Darvas ignored them all. He did not enter based on perception or anticipation. Days later, one stock broke its box structure, volume confirmed strength, and price respected the breakout. He entered calmly, efficiently, and without hesitation. Takeaway rule. Price confirms truth before news does. Amateurs anticipate, chasing patterns before confirmation, relying on rumor, hope, or gut feeling. Professionals respond, letting the market dictate action. This approach reduces false trades and emotional interference. Darvas observed that premature entry is the silent killer of accounts. A trade that looks obvious before confirmation often collapses, leaving amateurs frozen or panicking. Waiting for confirmation aligns probability with execution. Mini story. On one occasion, he noticed several stocks forming boxes near pivotal points. Everyone was eager to buy the cheap opportunities. Darvas ignored them. Only when the tape confirmed a breakout did he act. The entry was precise, risk-controlled, and psychologically effortless because it had the tape's approval. Another paradox arises here. The less you force entry, the more trades succeed. Anticipation creates emotional friction. Response creates alignment. Amateurs enter to feel productive. Professionals enter to let probabilities work. This principle affects every component of execution, from position sizing to stop placement. Waiting for confirmation also integrates naturally with pyramiding. Each addition is based on validated movement rather than speculation. Mini story. Darvas waited for the first breakout confirmation, added cautiously, and added again only after subsequent validations, compounding gains without ever increasing exposure beyond safe limits. The framework prevents impulsive scaling, ensures stops remain meaningful, and keeps psychology aligned with strategy. Another subtle insight is that confirmation is not just about entry. It informs exit strategy, stop adjustments, and position scaling. The tape communicates continuously. Ignoring confirmation at any stage invites losses. By responding instead of predicting, Darvas removed hope from the equation. Waiting became an active process, not passive inactivity. Amateurs see waiting as missed opportunity. Professionals see waiting as leverage. Another paradox. The market pays those who act correctly less frequently than those who act impulsively, but over time, correct action compounds into durable advantage. Confirmation also reduces noise and false signals, which are abundant in any market. It creates clarity, allowing selective action at pivotal points, maximizing reward-to-risk ratios. Professionals let price dictate participation. Amateurs let opinion dictate action. Darvas' commitment to confirmation created a feedback loop where structure, size, stops, and patience all harmonized. He trusted the tape entirely, responding only when price validated his judgment. That discipline transformed trading from guesswork into a process-driven system. Confirmation became the lens through which risk, size, and pyramiding were evaluated. The result was a methodology where trades were earned, not hoped for, and emotional interference was minimized. By prioritizing response over anticipation, Darvas consistently filtered winners from losers, preserved capital, and allowed probability to accumulate in his favor over time. Risk first. Size second. Stops enforced. Wait patiently. Pyramid winners. This sequence is deceptively simple but profoundly powerful. Nicholas Darvas discovered that the combination of these rules created a framework that could survive any market condition, compounding small wins into significant fortunes. Mini story. He followed this process meticulously. Each trade began with defined risk, often only 1 to 2% of his account. Position size was calculated based on stop distance and volatility, never emotion. Stops were placed without negotiation and honored without exception. He waited for confirmation, observing price, volume, and structure patiently, sometimes for days. Only after a trade proved itself did he pyramid winners, adding in measured increments while maintaining control over total exposure. This disciplined repetition turned thousands into millions, not overnight, but repeatably, systematically, and predictably. Takeaway rule. Process compounds faster than luck. Amateurs chase news, tip sheets, or hot tips, hoping for a windfall. Professionals follow rules, trust the tape, and let disciplined execution convert small edges into long-term advantage. Darvas realized early that risk management alone is insufficient. Without correct sizing, Even the most carefully chosen stop becomes meaningless. Too large a position creates emotional interference, panic, or impulsive exit. Too small a position wastes opportunity. Size must reflect structure, confirmation, and controlled risk. Once that is achieved, stops become functional rather than emotional. Mini story. On one breakout, Darvas observed a stock respecting pivotal points. He entered conservatively, stops tight, size calculated. When price confirmed, he added gradually, always aware of total exposure. Over several weeks, this single trade contributed more than many amateurs' entire monthly profits, all because rules dictated action rather than hope or fear. Another paradox emerges. Compounding results do not require high accuracy. They require consistent adherence to process. Accuracy matters less than behavior under pressure. Professionals survive losses, control risk, respect stops, and add to winners. Amateurs seek certainty, ignore stops, and mismanage size, often destroying accounts before understanding probability. Darvas' method integrates every principle. Risk defines behavior, behavior defines results. Size amplifies reward, but must never amplify risk beyond tolerance. Stops enforce discipline and remove hope. Waiting converts patience into advantage. Pyramiding converts selective wins into compounding gains. The combination creates a system that operates independently of emotion, speculation, or luck. Mini story. Over time, Darvas' account grew steadily. Each incremental gain was the product of disciplined repetition, not prediction or intuition. Losses were controlled, trades were selective, and pyramiding was applied only after confirmation. By trusting process over outcome, he converted repetition into compounding advantage, letting the market reveal opportunity without interference. Another subtle insight is that process also trains psychology. By focusing on execution rather than result, Darvas avoided ego-driven errors. Fear and greed became informative, not destructive. Patience became profitable, not frustrating. Every element of his framework reinforced the others, forming a self-correcting loop that continuously improved execution. The lesson is clear: the market rewards those who survive and execute. Luck may create a win occasionally, but process creates sustained, repeatable profit. By mastering risk, sizing, stops, waiting, and pyramiding, Darvas created a system where outcomes were a byproduct of discipline, not speculation, transforming ordinary trades into a long-term wealth-generating methodology that amateurs rarely understand or respect. Darvas never chased money. He understood that fortune is a byproduct, not a goal. What he chased was discipline, the invisible structure that governs behavior under pressure, filters emotion, and allows the market to work in your favor over time. Mini story. Early in his career, he pursued rapid gains, doubling positions on impulsive trades. Losses arrived immediately, wiping out weeks of profit. That experience forced a profound realization: chasing profit without rules is gambling, not trading. Discipline must come first, profit second. Takeaway rule: cut losses fast. The fastest way to survive is to accept being wrong immediately. Darvas never argued with price. He respected stops, exited decisively, and preserved capital for the next opportunity. Amateurs negotiate with losses, holding hope as a crutch. Professionals execute the plan and move on. Size small. Position size is the lever that controls emotion, magnifies clarity, and protects the account. Darvas calculated exposure relative to stop distance, volatility, and confirmation, never ego. Small size allowed him to think clearly, observe the tape, and wait for validation without panic. Mini story. On one breakout, he risked only a fraction of his account while observing price test a pivotal point. When confirmation arrived, he added incrementally. By the end of the move, the total gain was significant, but risk was never violated. Waiting patiently. Most traders act prematurely. Darvas waited for structure, confirmation, and pivotal points. Waiting is not inactivity, it is strategic restraint. It allows the tape to reveal probability, sharpens judgment, and converts patience into advantage. Amateurs view waiting as lost opportunity. Professionals see waiting as leverage. Mini story. During a period when multiple stocks formed boxes, Darvas observed quietly, letting others trade impulsively. Only when the breakout validated through price and volume did he enter. That patient restraint filtered out false moves and preserved both capital and psychology. Pyramid winners. Amateurs pyramid from hope. Professionals pyramid from strength. Darvas added to winners incrementally, always maintaining controlled risk. Each edition respected stops and structure, compounding gains without creating oversized exposure. Pyramiding turns small, consistent wins into substantial growth, leveraging rules rather than emotion. Own the process. Execution outweighs prediction. Traders who focus on outcome chase luck and expose themselves to risk. Professionals focus on behavior under pressure, letting probability and discipline dictate results. Mini story. Over months and years, Darvas' approach allowed him to compound steadily. He never sought immediate fortune. He sought repeatable, controllable actions. Each trade became procedural, predictable, and disciplined. By owning the process, he detached from ego, fear, and greed. Discipline became identity. Rules became freedom. Weighting, stops, sizing, and pyramiding integrated into a seamless framework that allowed capital and confidence to grow together. Another paradox is that chasing money often destroys it, while chasing discipline multiplies it. Darvas proved this principle repeatedly. Fortune followed because he prioritized structure, not outcome. Emotional neutrality replaced impulsive behavior. Patience replaced anxiety. Consistency replaced hope. Professionals survive long enough to let probability work in their favor. Amateurs disappear chasing edge after edge without structure. Darvas' final framework crystallizes everything he learned. Cut losses fast, size small, wait patiently, pyramid winners, and own the process. Every rule interlocks, reinforcing behavior and creating an environment where psychology, execution, and probability align. The market rewards those who adhere to process over those who chase result. If this reshaped how you see trading psychology, the next lesson on why most breakouts fail psychologically will deepen everything you've learned, revealing hidden pitfalls amateurs consistently overlook while professionals compound quietly.